Hey everyone, welcome to This Explainer. Have you ever wondered how companies worth literal billions of dollars are just constantly losing money? Well, today we're launching a fast-paced investigation into a massive financial mystery that's hiding right in plain sight inside India's startup ecosystem. Let's get right into it. Right out of the gate, we've got to look at this staggering reality. Out of the $126 billion unicorn companies in India, a massive 95 of them are operating at a total loss. I mean, think about that. The vast majority of the country's most celebrated, high-profile businesses are just constantly bleeding cash.
And it really sets up this wild paradox. Why is it that a simple street vendor, right, walks away with a guaranteed daily profit from a hard day's work, while these flashy startups, run by absolutely brilliant IIT and IIM founders and backed by millions in funding, are somehow running crores in loss? Like, is there just a fundamental flaw in the system here?
Well, okay. To figure this out, we first need to quickly define what separates your regular, everyday business from a true startup. A traditional business is all about routine commerce and steady, predictable profit. But a startup, it's about doing something entirely unique. It's about totally disrupting the norm and aiming for rapid, massive scale. They are literally prioritizing explosive growth over immediate, steady profit.
And because they're introducing entirely new concepts and, honestly, forcing changes in consumer habits, these startups carry a massive burden. They basically have to burn huge amounts of cash on aggressive marketing and deep initial discounts just to convince you to try their product in the first place. So, the big question is, who's actually responsible for this crazy culture of burning cash without generating profit?
Let's investigate Suspect 1, the investor.
You see, it all comes down to the valuation cycle. It goes like this. Investors fund heavy marketing to artificially pump up sales numbers. And since startup valuations are usually based on a multiple of sales rather than actual profits, these inflated sales automatically drive up the company's overall valuation. Why? Well, it allows those early investors to exit with a massive profit by selling their stake to the next investor, completely ignoring whether the company actually makes any real money. But hey, the investors aren't acting alone here.
That brings us to Suspect 2, the founder.
Look, to keep their company alive and secure that crucial next funding check, founders are essentially forced to abandon their initial focus. They start out in phase 1, focusing on core product innovation. But then they have to completely pivot to phase 2, which is just chasing aggressive marketing and hunting for higher valuations. Because honestly, if they don't show exponential sales growth, that funding completely dries up.
And you can really see how this translates into real-world business decisions. Take companies like Zomato. They are constantly pushed to pivot into entirely new sectors. I mean, they went from simple menu listings to table booking, then food delivery, quick commerce, and now even event ticketing. It's all just to show that explosive 10x growth that their investors are demanding. The actual core focus just drifts further and further away from foundational profitability. But wait, we can't solve this mystery without looking at the most dangerous participant of all.
Suspect 3, the customer.
The source material actually highlights a pretty hilarious but harsh truth. Indian consumers kind of act like Salman Khan in the movie Wanted. We have absolutely zero brand loyalty. As this quote perfectly captures, consumers aren't loyal to the brand. They are loyal to the discount. Whoever has the biggest price drop today wins.
Startups usually expect to endure maybe a year of losses to build up that brand loyalty, right? The hope is that customers will stick around once the freebies end. But the Indian consumer completely outsmarts the model. We just create multiple new accounts for freebies, app hop all day for the best deals, or even cancel rides to pay drivers directly in cash. It completely shatters the startup's planned path to profitability. So if investors are flipping shares, founders are chasing metrics, and customers are gaming the discounts, who actually get stuck holding the bag at the very end?
The ultimate exit strategy, the IPO.
This is the crucial point, how the final exit actually happens. Post-COVID, there was a ton of cheap money floating around, and startup valuations absolutely skyrocketed. But when the market eventually tightened, a SEBI rule change came along that actually allowed loss-making startups to go public. Suddenly, those early investors who were stuck holding these highly overvalued, unprofitable companies found their perfect exit strategy. They just dumped these companies onto the public stock market through an IPO.
Take a really close look at this share allocation for these IPOs. A massive 75% goes to qualified institutional buyers, which crucially includes mutual funds, and another 10% goes directly to retail investors. That means a staggering 85% of these highly overvalued shares are scooped up by the everyday public. meaning your monthly mutual fund SIPs are indirectly funding these massive startup losses.
It's honestly the ultimate financial twist of the modern economy. Those freebies, the extreme convenience, and the massive discounts you eagerly consumed on your favorite apps, yeah, they were never actually free. They're ultimately being subsidized by the very money you yourself have invested for your own financial future. Wild, right? So, now that we've demystified the actual mechanics of India's startup ecosystem and revealed who pays the ultimate price, will you ever view a 50% off discount or a hyped-up tech IPO the exact same way again? It's a fascinating, if somewhat scary, cycle of modern business. Thanks so much for joining me today for this explainer, and hey, please make sure to subscribe to the channel for more deep-dive business explainers just like this one. See you next time.